This is an RNZ podcast.
Hello and welcome to this episode of Your Money with me, Mary Holm. Thanks for taking just a few minutes to listen in while Jesse Mulligan and I talk through some useful ideas about how to make your money work better for you. Just remember though, this is guidance. Final decisions are up to you. Over to Jesse.
Hello, Mary Holm.
Hello, Jesse.
Sorry to keep you waiting today. It's been a busy day.
That's all right. And look, what a wonderful show you've had so far. I thought you've had lots of music. You've had the Daffodils, which I can't wait to go and see.
Yeah.
You've had Frank Sargison, which was fascinating. And then gun controls. Yay.
Yeah, fantastic.
So it's quite a tough act to follow.
Can I say Daffodils, by the way? I saw the stage. Did you see it in the theatre?
No, I didn't.
Okay.
No.
It reminded me of a feeling that I haven't had since going to see Romeo and Juliet for a second time, which is that you know how the thing ends and you go and watch it anyway and you end up getting heartbroken all over again.
Oh, God, yes, isn't that funny the way that happens? Yeah.
Mary Holm is with me in our Auckland studio talking about rainy day money. Let's get straight into it, eh?
Yes.
Should we start with the letter or would you like to...
There was one letter that came in today about ANZ. Should we start with that?
Yes, great.
That's interesting.
Let's do that. If only I can find it. So yesterday, ANZ went offline for an hour or two and got me thinking, imagine a major outage. If I don't have paper records and the bank doesn't, then how does anyone prove what they have or haven't got?
Yeah, and I thought this is a different definition of rainy day or emergency money, really.
Yeah.
I haven't got any magic answer to that. I mean, I suppose you could say every month people should be printing out I still get my bank statements in the mail, actually, because out of preference.
They must have backups.
Yeah, they must. And look, if the whole banking system crashes, we might all be out there bartering anyway. But I don't have a quick answer to that, actually. But
swap your chicken for a bag of oats, Mary.
Yes, exactly.
Yeah.
Yes,
okay.
yeah. But talking about rainy day money, individual people's rainy day money, how much you need and whether you've got it, and that depends to some extent on what insurance you've got. And so they sort of counter one another. If you've got life insurance and house and content insurance and car insurance and so on, then
income insurance,
yes,
income protection,
very
that sort of
important.
thing.
Yeah, income insurance. Then you don't need as much rainy day money really, but we're talking more for perhaps smaller things than your house burning down and that kind of stuff. But perhaps the car breaking down and you need to get it fixed fast.
That can be expensive.
So, yeah, it can. It's horrific the way they can. And things like that happen out of the blue. You've got a rough idea when most of your bills are coming in and you've got a rough idea that the power bill is going to be higher in the winter, etc. But things like car breaking down can just really hit people. And I think this is terribly important because it's how people get themselves into big financial trouble.
Right.
You hear about it all the time. People are just managing. They're earning a certain amount of money and then they're managing to cover. Although I was horrified when somebody the other day told me that some people go to payday lenders, that's the very high interest rate short-term loans, just to buy food. And if anyone's in that sort of situation, I would highly recommend they go to FinCap. Look at FinCap online and they'll help you with budgeting and so on. But we're talking more about when the unexpected things happen.
Yeah, I just thought maybe someone dies and you need to take a last-minute plane flight overseas to a funeral or to...
That's a really good example of the sort of thing that can come right out of the blue. And so how much you need is, that's the old how long is a piece of string, really. Quite a lot of people say 3 months' worth of spending. And, people don't immediately know what they spend over 3 months. You think, oh, gosh, I'm not sure about that. The easy way to get a rough idea of 3 months of spending is to look at 3 months of income, because we've got a better idea of that, of what's coming in, and subtract your savings from it, and the rest of it you're spending, basically, and it gives you a rough idea. Okay. I've heard some people say 6 months of spending, but I think that's perhaps a bit unrealistic.
That's right. You can change your behaviour when this emergency comes. If you lose your job, for example, you're obviously not going to keep going out and buying extravagant items and going out to dinner until you got the situation sorted. Yeah.
Hopefully not.
Hopefully not, yeah.
Yeah. And obviously, how much you need depends on what insurance you've got, depends on your family and friends, depends on whether you've got a mortgage. We'll get onto that in a minute about how you can use that to help you in a rainy day situation. KiwiSaver, you can get money out if you're in big financial trouble, but I don't recommend anyone ever counts on being able to do that because it's really quite hard to do.
Is it?
And yeah.
I saw a story that people were doing it more often these days.
Yes, and they might have eased up a little bit on it, but I know that the providers and the trustees who actually make the decision are pretty strict. They don't want people, going into their KiwiSaver long-term savings unless they're really in dire straits. But you can. It's probably easier to get it out if you develop a really serious illness. Easier to get your KiwiSaver money out at that point. But even then, I don't think it's a good idea for people to sort of count on.
Don't treat it as your rainy day fund.
No, not really. And another point I just wanted to make up front here is if you haven't got money set aside, it's a really good idea if you get an inheritance, you get redundancy money, something like that, grab some of that, get $1,000, several $1,000 ideally set aside. If you haven't got any redundancies or inheritances or anything coming in, start saving $10 a week, $50 a week, something like that, and get it into a savings account in the meantime we'll talk in a minute about some sort of more sophisticated ways you can use the money and store the money, but it's really important because it's how people get themselves into financial distress when they haven't got this rainy day money. Yeah. Now you had a letter from somebody that I sent in to you that starts about my partner and I bought our first house. Yeah.
Yes, we bought our first house 3 months ago and we're unsure how much cash savings we should keep in hand. We assume that some cash savings for the unexpected is sensible, but deciding how much has us a bit stumped. Our mortgage is a combination of mostly fixed and a small floating mortgage, so we're able to make extra payments when we can afford it. Thanks, Michael.
Yeah, so Michael's obviously, he's starting out saying we need savings for the unexpected, and then he talks about his mortgage. So clearly he knows that's one way and it's a good way, if you've got a mortgage, to use your mortgage in a way that gives you some rainy day money by basically by making extra payments on the mortgage. But really important to go to your lender and say to them, if I make extra payments on the mortgage, can I get that money back out if I need it? And typically they'll say you can. And in fact, even if you can't afford to make extra payments, sometimes if you're just making your regular payments on the mortgage and you need money in a real emergency, go to the lender and ask them if you can borrow back some money, i.e. add to the mortgage at that point. And often they'll let you do that. But I would really recommend to people that they do that before the emergency. Go today, go tomorrow, talk to the lender and say, if I get into trouble, would I be able to borrow some back and under what circumstances? And so you've got an idea. But, that's a way of sort of ideally pay a bit extra off the mortgage so you can do that, or get a revolving credit mortgage, or what's sometimes called a redrawable mortgage, where with a revolving credit mortgage you can just add to the mortgage automatically. We've talked about them before. I won't go into detail about it today, and with a redrawable mortgage you can get the money out. That's sort of what it means, that you can withdraw money again later. But even if you've got an ordinary mortgage, it's a really good way, because in the end if you're borrowing extra money, adding to the mortgage, or taking out money you had put into it, you're basically paying mortgage interest rates on this rainy day money, which are pretty low, much, much better than running up credit card debt. So I highly recommend that for those who've got a mortgage. But then not everybody has a mortgage. They don't own a home, or if they're lucky enough, they've paid their mortgage off. Yeah. So
Or things are so tight with the mortgage that they haven't kind of got that lump sum thing happening, and for whatever reason can't
add
get
to
it back out again. Yeah.
Yes, yeah. So there's lots of people where that wouldn't work. So you want to get your money somewhere where it's not too readily accessible. We don't want people thinking, oh, I've been working too hard lately, I badly need a holiday, I'm going to use my rainy day money for that. You've got to keep it for when you really want it. So you don't want it to be too easy to get out, which unfortunately revolving credit mortgages are.
Yeah.
You want to have a little bit of a barrier there, at least a psychological barrier. So I think it might be good if you read the next letter, actually, because this is
Yes,
someone with these ideas.
I've
Yes.
calculated, says Heather, 3 months of my salary to put aside from an inheritance for an emergency fund. Would I be best to invest it as a lump sum on 1 month term deposits, or split it into different amounts and stagger it on different lengths of term deposits? I'd also been thinking of maybe putting it into a bank account I could access. Heather's obviously a keen reader of yours, Mary. She thinks like you do.
Yes.
And maybe I'll just throw this one in because someone sent a text in today saying, yeah, what about throwing it in the share market with an exchange traded fund? Well, maybe that's going to confuse things. Let's stick with the letter anyway for starters.
Yes, maybe we should start with Heather first, she's looking at a 1 month term deposit, which is a good idea because the money's not too readily accessible, and if you've got a credit card and you keep the credit card balance low, in other words, you pay it off every month, then you can borrow against the credit card, and within a month, that 1 month term deposit will have matured before you have to make the extra payments on the credit card.
Yeah.
So in that way, you're earning some interest on the 1 month term
Not
deposit.
much.
Not a lot, but a bit more than in a bank savings account probably, and it's also a bit less accessible, which is quite
Yes.
good. And what Heather's also thinking about is staggering the length of the term deposits, and that's something we've talked about before, where you might have 3 month deposits or 6 month deposits, but set them up so that you've got one maturing every month, and that way you're probably going to get higher interest on the money, and but you still have some coming available every month. So
That's extra for experts say. That's super organised.
yeah, and it's something that some people will enjoy setting up, and other people will say, I don't know what Mary's talking about.
Yeah.
This is all too hard. And if it is too hard, just go for the 1 month term deposits. Or there are bank accounts that pay interest but don't pay you if you take the money out. I've got one of those that I don't use very wisely, I have to admit, but where so they pay you interest, and then if there's a month when you take the money out, you don't get interest that month, and so that gives you a disincentive.
They used to be quite
to
good
take
there.
it.
I remember in sort of like early 2000s, it'd be
Yes.
6.5% or something.
Yes,
Yeah.
and I look,
Those are the days.
bank account interest is pathetic these days, and I do recommend everybody looks on interest.co.nz and don't just go with what your bank's offering, because some of the banks are offering slightly better term deposit rates and bank account rates. But then we had this one text you sent. Yes.
Saying I reckon put them in exchange traded funds. That's basically a fancy way of saying sort of an index fund. Make sure you've got plenty of headroom on your credit cards. And so in an emergency, it's easy to sell your shares. You can use a credit card in the interim, but your reluctance to sell the shares will be good discipline to avoid blowing those funds in sort of
Yeah.
momentary enthusiasm. I thought that was pretty good.
It is an interesting idea. So you're doing it with the credit card once again, or not necessarily, but typically an exchange-traded fund is a share fund. It's like a KiwiSaver fund, really, we can't do it with KiwiSaver because you can't access the money. So
Sorry, Mary, we've only got about a minute as well, just to
have
let you
we?
know. Yeah.
Yes, yeah. So, and ideally you don't want to be taking money out of a share fund at short notice because the markets might have just gone down. But if it's just a fund that you're only going to go into occasionally when there's a big emergency, well, why not actually? Because most of the time it'll be in there, as the person says, growing faster than in a bank account. So one other idea I had, if we've got 1 minute for it, is a friend of mine in America used to, at the beginning of every year, he'd set aside a couple of $1,000s in a bank account and take money out of there if there was some kind of unexpected spending happening. And if there wasn't, he'd give it to charity. So he sort of said at the beginning of the year, this goes to charity if I have a good year, but if I have a bad year, it goes to me. And that's sort of one interesting way of taking care of some emergency money. But
Right.
my final point would just be, if you raid the fund, please top it up again as fast as possible, because otherwise this is how people get into big financial trouble.
Thanks so much.
It's a pleasure.
Mary Holm, whose podcasts are available on our website, rnz.co.nz. Head to the podcast page and you can listen to this and other sessions in the convenience of your favourite podcast app.